Deductibles in industrial fire insurance. In recent times, the subject of deductibles in industrial fire insurance has gained significance to an increasing extent. In fact, up to a short time ago, it was by no means common to apply deductibles in industrial fire insurance in Europe. The situation is entirely different in the USA, where deductibles are the usual thing and are even obligatory, with individual risk categories like petroleum refineries, hazard like explosion, or special type of companies like factory mutuals. Today, however, there is a definite increase in the demand for deductibles in industrial fire insurance in Europe too. This trend may be explained by the fact that in order to reorganize their business successfully, insurers have been forced to increase their premium by a considerable amount. It seems to be an unwritten law that when premiums in general are increased considerably, the point will sometime or other be reached when the insured do not accept any further premium increases. Thus, even if such increases are completely justified in a view of claim experience, the insured will demand that premiums are reduced either by the insurer granting rebates for appropriate loss prevention measures or by the introduction of deductibles. In the USA, for example, such a situation arose around 1960 when considerable premium increases very quickly led to the introduction of substantial deductibles in industrial business. In some European countries, we are currently experiencing a similar development. Why are deductibles introduced and what purpose do they have? When introducing or propagating deductibles, insurers may have various objectives. Basically, however, it is hoped that when a deductible is introduced, the moral hazard involved will be improved since in such a case, the insured will show greater interest in loss prevention and loss reduction. After all, whenever a loss does occur under a policy with the deductible, the insured will have to bear part of the financial burden himself. Another very important point is that when a deductible is applied, the insurer will not have to settle small losses anymore, which obviously relieve him of a considerable amount of work. One must therefore appreciate that the value of a deductible cannot only be measured in terms of the amount involved. Rather, one has to make allowance for the settlement expenditure saved by the fact that the insurer isn't liable for minor losses. A further advantage is that if a deductible is applied without a premium reduction, it can be used to improve the structure of underrated risk, as in such cases the deductible constitutes an indirect premium increase. On the other hand, the advantage offered to the insured is that the premium he must pay to obtain insurance coverage is reduced. Together with the policy of granting rebates to the insured whenever he takes effective loss prevention measures, deductibles are therefore suitable for helping an insurer keep his market and prevent good risks from moving over to outside the market from the local market. Similarly, by avoiding premium increases through the introduction of deductibles, the insurer can keep his business attractive for the policyholder, thus preventing any trend toward self-insurance. Finally, it should also be considered that without deductibles, it would be entirely impossible in some cases to cover severe risks. Definition of a deductible and the difference between deductibles and excess of loss insurance. A deductible can be defined as the participation of the insured in a loss up to a certain limit agreed on in advance. Although this definition is very closely related to the definition of excess of loss insurance, The basic difference between the two is that excess of loss insurance is usually concluded on a first loss basis, where the sum insured doesn't fully correspond to the value of the risk, whereas in the case of a deductible, the traditional concept of full value insurance with its underinsurance clauses remain unaffected. Speaking of deductibles as such, we may basically distinguish between amount deductibles and time deductibles. Referring Timon deductibles first of all, the most important category we have here is that of the so-called pure deductible, where the insurer doesn't provide any indemnification at all for losses below the amount agreed on, while when indemnifying losses exceeding the amount, he will be responsible for the claim minus the deductible amount. When applying another kind of deductible, the so-called franchise, the insurer is required to indemnify any losses exceeding the agreed limit in full, or he cannot deduct the insured share, while the insured is responsible for any losses lower than the amount agreed on. The reason why such franchises are not as common as pure deductibles is most probably because policyholders always feel rather annoyed when they have to pay losses just below the fixed amount. The situation is similar when one applies the so-called disappearing deductible, which is a kind of combination of a pure deductible and a franchise. The special characteristic of this disappearing franchise is that the insured is liable for all losses up to the amount agreed on, which makes this the same as a pure deductible, while the insured share is reduced as the amount of the claim increases, so that when a certain limit is reached, the insured doesn't have to pay anything at all. It can be seen, therefore, that of the various kind of amount deductibles, the deductible as such is the easiest to use. Compared with the franchise, it offers the advantage of being non-manipulatable, so that indemnification doesn't depend on whether a loss has exceeded the amount fixed or not. When applying a time deductible, the deductible is defined in units of time. It is obvious, therefore, that such deductibles are only possible with an insurance where a loss occurs over a certain period of time and is not an instantaneous event. Thus, a time deductible is quite suitable in fire loss of profit insurance. When applying a time deductible, we must again distinguish between two different types. First of all, there is the pure time deductible, as such where the insured is responsible for that share of loss constituted by the period agreed on, while secondly, we also have proportionate time deductibles where the insured pays a certain percentage in the overall loss resulting from the ratio between the time of the deductible and the duration of the loss as a whole. As proportionate time deductibles cannot be manipulated in any way, they appear preferable to standard time deductibles, where the insured has the possibility in some cases of limiting the amount of a claim for, say, the first 3 days, thus increasing it for the following period and manipulating loss development. As there are still considerable difficulties in calculating rebates for time deductibles, we shall confine ourselves to pure amount deductible in the following. Rebate calculation with deductibles. Assuming that the basic premium provided for in the tariff is correct, the question of calculating the rebate is of first and foremost importance when introducing a deductible. With this in mind, it should therefore be noted that the gross premium charged by the insurer is made up of the following components. The risk premium required for covering claim expenditure on the basis of the equivalence principle. The cost surcharge, and here it is sufficient in the present context to distinguish between the cost of claim settlement and the cost item which are dependent and independent of the premium and the profit margin. Thank you.